So, Bob, what have you been working on recently?
As usual, not that much. Actually, I'm in the middle of writing up a blog. I do this twice a year. I've been doing it for a while. It's called the Registration Market Analysis.
Why do we do the registration market analysis?
Every company kind of does an analysis of their own position within a market, kind of internally to understand how they're doing and kind of measure themselves against different benchmarks and so forth. And being kind of the open company that we are, we decided to publish that.
So, what's happening with races so far in 2024?
Well, actually, some really good stats are coming up. So at the end of each month, what we do is we measure and we compare all of the races that were on our platform in 2023 in January to the races that are still on our platform in January of 2024. And that way we can get like a direct apples and apples comparison of what's happening with registration trends. And if you recall, 23 was kind of almost back to 2019 numbers. So it was like down just 1%. So far, both in January and February, and they were both the same exact number, up 7%. So that is like really good news because it means that all the boats are floating upwards because we've got rising tides.
So, how is RunSignup doing?
Actually, really well. Knock on wood.
Good.
Our registration numbers are up about 14%. So what it kind of indicates is that we're kind of continuing to aggregate market share. And kind of the last time I did this report, we kind of estimated that we're around 40 or 45% market share. And we're kind of picking up, I don't know, maybe like five points of market share each year. You can kind of tell it in those registration numbers. You can kind of tell it in like how many races are happening and how many races we're taking registrations for in current months and stuff like that. And so like the volume of races kind of increases about 10% on our platform on a year-to-year basis. So the numbers are really quite good. I'd say it's safe to say that somewhere in the next year or so, we're approaching 50% market share. So in the U.S., so basically half of all the races in the U.S. are going to be on RunSignup, which is just amazing. Having started this thing 14 years ago to see, kind of what we built and how much people like it. It's just really gratifying.
And what is happening with the other vendors out there?
I think that, we're kind of making it a little difficult in the market. I mean, if we're basically the same size as all the other vendors combined, it's difficult for those vendors in a couple of ways. We've got this great development team and development process. We release a couple thousand new features a year or, incremental improvements each year. And it's kind of tough for people to keep up with that. And so we're at this position now where, we've kind of got more features in our software and we're improving faster than others and our price is actually lower. So it is difficult out there. There are companies that are doing okay. Kind of the big kind of thing that happened in the past 6 months or something like that, just for other vendors, is that Atlanta Track Club, which is a large track club, and they put on the Peachtree race and a number of other races, they were customers of Haku. Haku's a well-known registration platform. I have actually a lot of respect for them and the people that are there. They work really hard, but they tend to focus on kind of the higher level races that want custom types of features built for them. Actually, Atlanta Truck Club left Haku and went to this kind of new company, Let's Do This. Let's Do This is this UK company, and they've gotten just like $80 million of venture funding, which I have a difficult time wrapping my head around. But they're basically... my observation is that they're spending a lot of money to try to win customers kind of ahead of their product having the features to actually earn customers. So I don't know what happened inside of Atlanta Track Club. Rich Kenna, the executive director there, been pretty public that they've lost money the past couple of years and that they needed, to make changes and so forth. So that might have had something to do with it, where Let's Do This helped them financially, or they thought Let's Do This would help them financially in some way, shape, or form. But that was pretty earth-shaking. That's the big earth-shaking news. If we look at Haku, I think they're doing okay. They're expanding beyond just kind of the top races in the U.S. being a target to also include nonprofits, much like our GiveSignup efforts. And they're also expanding internationally. So they're kind of moving aggressively into Europe, and they've, sponsored conferences in Europe and things like that. It's going to be interesting to see how that plays out over time. They do have outside funding, it'll be interesting to see if they're able to kind of keep it up. Part of the problem that they have, I think, will be, do they get an accumulation of technical debt that kind of slows them down after a while? Meaning, if they're doing custom stuff for individual races, is it something that they can kind of continue to support across all those races, or are there too many custom things that don't allow them to have a single platform and to make 2,000 releases a year and things like that? Let's Do This. We had seen them try to make a push about a year and a half ago into the U.S., and they had kind of disappeared until this Atlanta Track Club thing. We still don't see very much of them. We see them having extraordinarily aggressive marketing tactics in going after races. They seem to have scraped our website recently and have all of our races, and are trying to get race directors to claim their race on Let's Do This and to try to open up registration on Let's Do This. It's kind of a strange approach. It's aggressive. It'll be interesting to see how that works out over time for them.
So they're setting up their race on their site and then telling people to go claim it?
Yeah.
Okay.
Basically, they scrape our website for the information and the logos and the name and stuff like that, and then they'll have this big claim button. And so, like the Scott Coffee run, if you go on Let's Do This, it'll have a big claim button, and you can click the claim button and then give Let's Do This all of your information. One of the central themes of Let's Do This, it's kind of like the old active days, where what they're trying to do is they're trying to become a marketplace. It's kind of similar to Eventbrite's current moves, actually. So they basically own the participant data, and so then they can remarket to those participants. So if you and I each have races, they're taking the data from your race and helping to market my race, and vice versa. I have my sincere doubts about that business philosophy. Again, we'll see how that works out for them. Race Roster is kind of the other one that has, a fair amount of usage and has some amount of momentum. In the U.S., and they have recently, I guess it was maybe 6 or 8 months ago, they did a pretty major price increase. So now their kind of list price is, they charge like $1.99 per participant plus 6.99%. And our rate's $1 per transaction, not per participant, and then 6%, and then we charge a flat 4% for donations. So we're significantly underneath them. They tend to be a couple of years behind us in terms of feature functionality. They've got a decent platform, and from the metrics that I've been tracking, they're probably about 20% of our size, meaning that we're about 5 times their size in the U.S. Now, ASICS, which is their parent company, has been aggressive in terms of acquiring registration companies. So they acquired Race Roster, and Race Roster kind of has a de facto monopoly up in Canada. We may enter Canada in 2025 to be determined still, but they've got that market kind of locked up. And then they bought this company Nuco in Europe, and Nuco has probably millions of registrations in Europe. What's really and they also bought a company in Japan and a company in Australia. What's really interesting is the pricing difference between Nuco and Race Roster. Nuco pricing is more like 30 cents for a transaction or for a participant. And then whatever the credit card fees are, like 2.9%. In Europe, credit card fees are typically a lot lower than they are in the U.S. So the overall economics are much different. And it's interesting that ASICS seems to be supporting aggressive pricing for Nuco, and my guess would be that they kind of insisted on Race Roster increasing their prices to generate more cash flow and more profitability from that part of the entity. So it's tough to understand what's happening there. We've also noticed that the amount of aggressiveness in their sales efforts has decreased. So like they no longer sponsor Running USA. Haku took that over. And a year and a half, 2-3 years ago, they were kind of buying customers, giving them, pretty big discounts and offering them a whole bunch of ASICS gear to kind of win the business. And we're seeing that not happen anymore in the U.S. So it'll be interesting to see what happens with all three of these vendors over the next couple of years. After those three vendors, there's really not a lot to say. I mean, there's kind of these smaller vendors, Enmotive, Chronotrack, Race Entry, Race Reach. There's a whole list of them, and we have them all documented in this blog that I'm writing. But they're all pretty insignificant. RunSignup is 10 or 20 times or more larger than them now. So they've got some customers that are loyal to them, or it's just too hard to change, or they don't have the time and energy to change right now. But it's difficult for them to try to see how they can catch up in terms of just basically what all the platforms are trying to offer is technology for the customers. It kind of the nutshell of our analysis is that we seem to be continuing to pick up market share. We're positioned very well to kind of continue that trend because of the strong product, focus that we have, and differentiation there, and just the fact that we built an extraordinarily efficient business where we're actually making a profit off of much lower fees than all of these vendors that I just mentioned, which allow us to operate an employee-owned company. So we don't have to have outside investors, and we have no real goals in mind to quote unquote sell the company. That's not the goal of this company. The goal is to kind of keep having fun, keep building software, keep making our customers happy. So the analysis is, 2 thumbs up or something like that. Yeah.
All right.
Yeah.
Thanks, Bob.
Thanks.